Well, what do we have to say about open market operations versus other tools? Open market operations are most definitely the preferred tool of the Fed and of most other central banks at this point, not necessarily all of them. A big reason why the Fed uses them is because they simply work the best. The Fed basically has full control over the Fed funds market through open market operations that can change the supply of bank reserves. The discount window can typically only be used if banks actually ask for loans. Sometimes the Fed tries to shop loans around a little bit, but it's not really something that the Fed has direct control over. Banks actually have to ask. And as we've discussed, there are problems with revealing information. It is known that adverse selection would produce demand for Fed discount loans only from those banks that were in trouble. Banks are aware of that, so typically banks don't ask for discount loans. Only during extremely bad times do banks actually do that. The Fed has used the discount window during certain times of crisis, and that seems like it's happened more recent, or quite a bit more recently, in the past, say, 2 to 3 decades. In 1987, when the stock market crashed, in 2001 during the tech bust, and again, of course, in 2008 during the Great Recession. Reserve requirements are a very blunt tool, and they're barely ever used now. And the argument is that they are more like a bank regulation, and changing them is a bit more unsettling for banks than changing the Fed funds rate through open market operations. Well, the thing is that Fed policy today, 2 years after the collapse of Lehman Brothers and what roiled the financial markets in 2008, looks a little different from normal Fed policy. The Fed funds target rate, as I showed you in an earlier graph, has been between 0 and 0.25% since December 16th, 2008. Let me just show you that actually again. This bears repeating. So here's the Fed funds target rate. Sometimes the actual rate is different. There's the actual rate, but you can see that we basically have been down at 0 for 2 years now. So it's been a very, very long period of time. Fed policy has had to adjust. The Fed can't lower the target anymore. A zero interest rate would mean that banks actually give each other excess reserves for free. They'd never do that. So the Fed funds rate is actually slightly above 0%. A negative interest rate would mean something even more perverse, that lenders would be paying borrowers to take their money, and that would really never happen. But the problem is that unemployment is still 9.6%. You can think of this in the ISMP diagram as an IS curve that is still shifted quite a bit to the left. Annual inflation is only 1.1%. Core inflation, which is inflation minus food and energy, is even lower at about 0.6. So the Fed has undertaken several rounds of what is commonly called quantitative easing. It's a type of monetary policy that is more directly tied into the quantity of credit, or, well, in some sense anyway. They're still aiming for interest rates that are lower. That's really a big part of it still. But it's commonly called quantitative easing. Rather than lower the Fed funds rate, because it can't go any lower, the Fed is purchasing other types of assets. And the current round, what's called in the media QE2 or quantitative easing round 2, are Treasury securities. Earlier versions of this were other types of assets. So the TARP was set up, for example, to purchase toxic assets. We talked in class about how the Fed bought commercial paper, which is not toxic, but at the time they felt they needed to provide liquidity to the commercial paper market back in 2008, and they did. QE2, the most recent quantitative easing round, however, is all about buying Treasury securities. And so this was announced at its most recent meeting on November 3rd. The FOMC said it would buy another $600 billion of Treasury securities before July 2011. And the idea is to basically raise the monetary base, also to lower the interest rates on these government securities. And so what they're thinking about here is increasing the money supply and hopefully increasing credit to families and businesses. And so the question that you should probably ask yourself is, will this work? Well, we saw this graph before. This is showing us over time the levels of the monetary base in blue and the money supply in red. Quantitative easing seems to have created some increase in M1 back in 2008. That's when the big increase occurred at first. So that's the monetary base. As a result, M1 only rose modestly, and the issue is, well, what was happening to kind of stem this rise in the money supply? The big story, again, has been the huge increase in banks' excess reserves, and there seems to be no end in sight to this. So excess reserves were extremely low, with a small blip, I'm not even sure what that represents, back in, I guess it was late 2007. But then the excess reserve ratio just absolutely rocketed up. Banks have a lot of excess reserves. It's about $1 trillion or so. The currency ratio, which is the other thing that matters for the money supply, is what you and I determine. We determine how much cash to hold. And that actually fell a little bit, which is a bit counterintuitive perhaps. This thing has been a bit more stable over time. It's not really what we care quite so much about. Well, what are the risks of quantitative easing, of trying to expand the money supply, trying to lower these longer-term interest rates on government bonds, and perhaps also lower interest rates on bank loans? That's kind of the key thing that the Fed is trying to do. Well, inflation could rise with an increased amount of money in circulation. The basic argument, which is called quantity theory, and it's expressed in full on page 500 in Michigan's textbook in chapter 19, goes something like this. The money supply, capital M, times the speed at which the currency is used in a year, which is velocity, or capital V, has to buy nominal GDP, which is equal to the price level, P, times the level of real GDP, uppercase Y. If velocity is a constant, now it isn't in the short run, but over long periods of time it tends to be, then an increase in the money supply will typically raise the price level considerably, unless there's some big increase in GDP or something like that. And that's inflation. And if M rises a lot, inflation will become quite high. But expectations of inflation have remained pretty stable and have actually been consistently too high relative to what has happened. So this is a graph of expected inflation. That's the blue line, the one that is higher now, versus actual one-year inflation from the date of the expectation, which has been high and then very, very low during the big negative oil price shocks of, say, 2008, when the price of oil really cratered. And then back a little high again. But now, as we see, the current one-year inflation rate from October 09 is about 1%. That's where the red line ends. And inflation expectations, voiced, say, a year ago in October 09, you could see were quite a bit higher. People thought they expected inflation to be something like 2% or 2.1%. Even today, their expectations are fairly stable. What this may, of course, represent mostly is that people don't really know what inflation is going to be. The fact is that they have been wrong. And this is a measure that policymakers typically look at when they're trying to gauge whether or not there is danger of inflation. There seems to be very little danger of it based on this. People have been quite wrong about the level of inflation. Now, granted, back if you look in 2007, they were wrong in the wrong direction. They thought inflation would be lower than it was. The blue bar is below the red line there. And then they were wrong again in 2008 that the red line was significantly below the blue line. They were wrong on the other side there. They expected inflation. They actually found deflation. And now they seem to be wrong again. So you should probably wonder, well, how realistically useful this is. I think what is helpful is that inflation expectations are stable. They don't seem to be reflecting any fear that there will be a big uptick in inflation. So that's why the Fed is continuing to pursue policies that expand the money supply and expand credit as best that they can. And they are not concerned that much about inflation. It does not seem to be in the cards. Well, inflation could be caused either by an increase in the money supply or by an increase in economic activity through the Phillips curve, of course, but there's really very little evidence of inflation. And many Fed officials and economists now believe that actually the risk of deflation is really very real. And Fed policies will probably continue to include quantitative easing. Thank you. I will see you on Thursday for a review. Please come armed with questions.